Thank you, George. And really great to be here talking about what a subject that I love the most, which is stock picking. A little bit about myself. As Nico mentioned, I started my career at Drexel Burnham Lambert, where I learned, really appreciated and learned about the high yield bond business because of the creativity of Michael Milken. He created an asset class that previously didn't exist. Small companies able to access capital through the high yield bond market. And that's a pretty interesting place to start because we think of high yield bonds as being part of the leveraged buyout boom. And that definitely is a key component, but it started off funding small cap companies because these companies had no access to capital, no sponsorship, couldn't get credit ratings, and the corporate bond market wasn't open to these kinds of companies prior to Milken creating this whole asset class under the simple theory that I want to invest in emerging credits. Why would you want to buy a bond that's AAA rated because the next thing that's going to happen is likely going to be bad. They're not going to get a fourth A on their credit rating. It's going to go bad. You're better off buying low rated or unrated bonds of a company that's growing because that growth will pay off the debt obligations and you're actually taking less risk if you have a diversified portfolio. So the whole interplay of that really got me very interested in small cap stocks. And back in the 1980s, it was really just at the very beginning of the small cap universe becoming a legitimate institutional asset class. The Russell 2000 benchmark was only created in 1984. And there were no style boxes of growth or value or core even back till many, many years later. And I remember we got our first institutional mandate in 1987 of $15 million from a major pension fund. And I remember turning to my partners and saying, how are we going to deploy all that money into small cap stocks? Because the relative size of the small cap universe was so small back then and underfollowed. It was mainly banks and industrials back in that day. So, so I really appreciated how valuable management was as part of that. You buy a piece of real estate, it's location, location, location. When you're investing in small cap stocks, it's all about the management, and you live and die by their ability to manage their business. And it's so important, we'll get more into it later on in my presentation, the culture in a business. You're really investing in a culture in a company, and that's so important to the long-term success of the enterprise. So, in the mid-90s, I remember very distinctly I was really going through a crisis because everything I knew wasn't working in investing. Because then, Yahoo was newly public, Amazon was newly public. These were companies that were commanding multi-billion-dollar market caps and had barely any revenues and no line of sight for profitability. Yet, I'm looking at all these companies that are trading at low price earnings multiples and very strong asset value. And I'll highlight one company that I came across back then called the Genesee and Wyoming Railroad. This was a short line railroad company. And when I studied it, met the management team, they really were very steeped in understanding the railroad industry. And I'm like, there's just no way I'm going to lose money in this because it was trading at about 80% of tangible net worth, literally meaning you could have liquidated the locomotives and the track for 20% more than what the stock was trading, assigning no value to the enterprise value or the know-how of running a railroad. I'm like, there's no way I'm going to lose. So that was 1997, and in 2 years it dropped another 45% and was trading at about a 60% discount to net asset value. So that was a very expensive lesson learned. I had this big position, and when I thought about why it didn't work back then, it ultimately went from one of my worst picks to one of my best picks after that, because back in the late 90s, they struggled to grow. Remember, the short line railroad industry, you're functionally like a toll booth where you're connecting one railroad network to another. Well, the Class 1 railroads several of them had merged, so there was a lot of service disruption in the network that was reverberating to the short line railroads and really affecting the revenue growth opportunities. So the company wasn't generating enough cash to deploy capital, and it really wasn't a growth stock at all. And that's why I said, at that time, here I had a value stock, but at that time it was a value trap. So when I think about what shifted it from being a value trap to changing, they started making some acquisitions. They identified properties in Australia where they could essentially run for state-run enterprises their railroad operations and get paid a big fee. Long story short, it went from a 300 million equity capitalization, was acquired at the end of 2019 by Brookfield Infrastructure at a valuation of about $5.5–6 billion. So it went from worst to first, but the key missing ingredient was the company's ability to grow. It's not hard to find companies that are cheap, but where's the catalyst? Companies, how do companies, how do you unlock value? How does an enterprise grow? Simply having it just linger and sit around as a value is not going to make you any money at all. The enterprise has to put capital to work and get a return on that capital. So what I thought I would do is talk a little bit about the stock selection process. So I love this chart. This was put together by one of my partners, and it comes right out of, if it looks familiar to you, it's right out of the Danaher Business System, the DBS model. And for those who don't know much about Danaher, it's one of the greatest examples of a company that we call a select compounder. So you think about a corporation. Companies generate cash. What do they do with the cash? If they're in a specific business and it's generating cash, if you're Warren Buffett, he doesn't want them to do anything with it because he does not have a high opinion of management, rightfully so. He wants them to return the capital to him in the form of share repurchase programs or dividends. He doesn't want them to allocate capital. But we're looking for something a little bit different here. We're looking for companies that know how to deploy capital, how to take free cash flow and deploy it effectively. Well, where can you deploy capital? You can invest it in your own business in areas that are growing. You have a new product line that you're coming out with, needs some investment. That's one way you can get a return on that capital. Another is to make acquisitions. Most acquisitions fail, but what we try to monitor is an elite group of companies that have a long-term successful track record of making acquisitions and having improving the operations of those acquired companies. They generate more cash, and you get that compounding effect. So if you look at this, but it all has to start with a certain credo that you have to start with. The enterprise, you have to find a business culture that comes in every day trying to improve the business every day, trying to do more with less, trying to take capital out of the business to free it up to deploy it elsewhere. That's in the upper left-hand quadrant. We love to find companies that that are niche-oriented and do something that's differentiated. That's a great way to have a moat around your business, and also to have a more predictable margin structure for your business. You know, if you don't innovate, you're going to be disintermediated. So we always are focused on those companies that continue to take their businesses and innovate. And talent development. Warren Buffett, I think, spent a lot, very, very cautious and careful thought process for who his successor is going to be and who his successors are going to be. And he's still around, he's still active, but, Father Time is definitely going to catch up to him at some point. But the best companies plan succession way ahead of time, so it's seamless. I mean, things happen out of the blue, but the best companies have this down to a science where they have a stable and it becomes seamless as you transfer from one leadership team to the other. And then we try to focus on businesses that can't be that are resisted from being disruptive. You think about what's been the most disruptive company that's come in the last 50 years has certainly been Amazon. I mean, when you think of how they've put so many retailers out of business and just completely changed and upended so many business models, starting, I remember when it was all started around books, and that was the whole business model. And really, everybody is very much aligned, from the person sweeping the floor to the person occupying the C-suite. This cannot work unless the entire, not just management team, the operating people have to really understand this too. Then there's a focus on, lean execution, all these processes to improve and streamline the operation. So when we're looking at companies, we focus on key performance indicators. It's great when you have a growth company like NVIDIA, and we own some NVIDIA in our large cap portfolio, but that's probably the exception. We really prefer companies that are more moderate growers, high single digits, low double digit top line growth. Where you add acquisitions, you can kind of get into the low teens. And then this is very important. We can make earnings look anything we want to, but cash flow doesn't lie. And we're always trying, the best companies have a free cash flow conversion of 100% or greater to net income. And, from that, you get a competitive return on invested capital and cash flow return on invested capital. So, again, we're always monitoring and interacting with management and tracking what they're doing on their internal development, because then, so you have, companies have these silos of businesses that they're operating and constantly investing in and perfecting. And that's great, improving the product offering, listening very closely to the voice of the customer. That's also very important. But the best management teams have two ways of looking at their businesses. And this is probably the most important thing for uncovering the best stocks. When I think of the companies that have been our biggest winners, it's companies that can look in two dimensions. They know how to operate their silos of businesses, but then they can look horizontally at the whole portfolio and think like a portfolio manager. And to me, this is a much better way of investing if you can identify companies like this than investing in private equity. Because think about it, private equity is not very tax efficient, because eventually a private equity portfolio, you have to return the capital to the investors because there's a finite life to the fund that it's in. So they have to they're forced to sell it, regardless of whether they want to or not. They have to return and then raise a new fund and do that. The smartest companies make tough decisions. They'll have a subsidiary that does really well for a long period of time, but then come to the determination that this business no longer fits with them and would be a better fit with somebody else. George and I were chatting earlier about General Electric, and I think Larry Culp's done an extraordinary job turning around not just businesses, but a culture in that company that was definitely in bad need of repair. And of course, he's a former Danaher person, so he's very steeped in this flywheel. And then, again, we talked about, we have it in the lower quadrant there, the capital deployment decisions that are made. Where are the areas you can deploy capital? You can buy a company, you can buy your own stock back, or you can pay dividends. We prefer, and we think the better options are when companies make strategic acquisitions that make sense. The second best thing for us is to have the companies buy their own stock back. And, third on the list is dividends, because that really, you're telling me that we have no other places to put our capital. So we're returning it to you. We tend to have higher dividend growth than dividend yield. And I think that's also important too, because I can find high yielding stocks that are going nowhere. Just look at AT&T and Verizon, for example. Those are businesses that are doing better near term, but very difficult to say that they have they're long-term growth, companies. They generate a lot of cash, but they're wildly capital intensive as well. So we also try to identify those companies that also can be asset light. So for us, we screen through the Russell 3000 universe of stocks and do an initial review and then apply our fundamental research. And then, here's the part where it really gets very intense, our engagement with management. We want to hear, and we do this, we do keyword searches like capital deployment. You want to hear companies say some iteration of that statement. That means it's part of the DNA of the business. It's shocking how many companies don't really talk about capital deployment that way, or measure it in some way, or present a methodology for how you measure those decisions, because ultimately that's the report card on management. How did they do? What did they do with $1? Did they turn it into $1.05 or $1.10 and then take that $1.10 and reinvest it? That, it's no different than compound interest. And then, we're buying highly diversified companies. So our style in the large cap area, I'm speaking specifically in large cap, is to only own 20 to 30 stocks. I don't think you need to own more than that, because big companies are so diversified anyway. Oftentimes, I think when I put my portfolio manager hat on, portfolios are over diversified for the most part. And you're almost guaranteed to catch every falling knife. The areas that aren't terribly interesting to us are areas like utilities, because they don't really have great financial characteristics. You have a rate base. You're capped in terms of how much return you can make on your investments. Real estate investment trusts or business development companies, those are merely pass-through vehicles of the cash flow. There's no retained earnings, and you can't really measure any of the deployment activities. And that's just our own strategy. That's just how we do it. Doesn't mean that it's the only way to invest. And then, obviously you've got to monitor and keep watching. And the hardest thing is when a company has a setback, if they're going to have a bad quarter or two, whether that's something isolated and small, or something that's something that you've got to pay attention to. Personally, I've not experienced where a company only has one quarter. It's usually the roach theory. If there's one, there's a lot more problems there. You're just not seeing them yet. And we saw that many years ago with a company called Newell. They had acquired a company called Jarden, which was a diversified consumer branded company that had a whole host of different products, playing cards, skis, all kinds of things. And almost right out of the chute, we noticed a deterioration in free cash flow generation. And that caused us to, but analysts were making excuses. The stock went down a little bit, rebounded. And we weren't exactly sure it was a sell yet. But then the next quarter, the cash flow was deteriorating further, even though Wall Street was defending it. And, the stock had dropped something like 15% or so. But that was still another lesson learned is it's never too late to sell. I think we got rid of our last bit of shares in the 30s, and the stock got as low as $6 or $7 a share. So maybe we didn't make a lot of money, but we definitely protected client capital, even though we didn't get it right. Once we had the evidence, it was enough for us to take action. Yeah, and then here, for us, I think this is important to think about. You don't have to put your whole position. You don't have to get to a full position right away because stocks move up and down, and markets shift around and sectors shift around. So we try to build portfolios over time, but we start with a 1% to 3% weight, and we're comfortable holding as high as an 8% weight in a stock. So we really give the company enough room to run and generate alpha for our clients. For us, the key sectors really are the areas that match up with this style of investing. Investment, information technology, industrials, and healthcare. I mean, those are really, and then there's some minor sectors. Materials is a very small allocation for us, and as I said, utilities isn't going to be an area utilities and real estate are not going to be the areas. And then, stepping back now, we might think we're great at putting portfolios together, but then you've got to step back and do a risk analysis because there's intended bets in a portfolio and then there's unintended bets in a portfolio. And you think you're positioned a certain way, but you got to make sure that the risk statistics that you're deploying are backing that up. And there's been times you also have to have a risk budget. Sometimes an individual stock can do really well and it can be really volatile, which means it's taking up a big percentage of your risk budget. You have to be really confident and you have to be right about that. We don't own it, but I'll use the example of Palantir. I mean, that the stock is down 30% and it's still up 30% this year after being the best performing stock in the S&P last year. If somebody had that in their portfolio, they've got to recognize that it's a very volatile stock and it's highly risky. So you got to manage the position size so it doesn't occupy such a big percentage of your risk budget. Selling is the hardest thing to do because we're all type A personalities. We all want to be right. We all want to make sure, we all think that we picked the right thing, but sometimes you're wrong. And, if you're not losing money, if you're not making mistakes, you're not trying hard enough. If there's one piece of advice I can give you all is don't be afraid to make mistakes because this is an iterative process and mistakes are an important component of how you learn and do better. Just like the manufacturing process is a continuous improvement process, so is investing. I'm still learning. I'm still a student. I'm learning something new every day and I'm making mistakes every day. And that's how you have to approach this business. because it's a great business and you can do it for a long time once you really delve into it. And but we're going to make mistakes. So what are some of the big things? I touched on some of these things. A bad acquisition is simply a misallocation of capital. You got to own that. You got to acknowledge it. If it was a big acquisition that the company made, that could be a problem. If it's a small one, you can forgive that. But if there's a pattern that develops, you have to pay attention to that, where they're no longer making, is the industry changing and the company and management is whistling past the graveyard? Are competitive threats from other areas starting to come down? Pay attention to the key performance indicators. The earnings lie because a good accountant can make make earnings look any way you want to. But cash flow and free cash flow, they don't lie. That's where you really want to zero in on and really watch to see if there's any changes. And if there's a succession of leadership changes, that's bad. I mean, I know you all have been talking about Intel more recently. Previous leadership did a terrible job. The company currently doesn't have a CEO. They've got an interim CEO, which probably means nobody wants the job because it's too difficult an enterprise to perhaps turn around. So maybe it needs to be chopped up and sold off in pieces, as some of the media are reporting. I don't know. And as I touched on again, position size. Make sure your position sizes are manageable. So I thought I'd pause there, see if anybody had any questions specifically on this, because I want to switch over to what I think is a big secular shift in the markets that's starting right now. I've been in the small cap arena, as I mentioned, since the 1980s, and like everything else, small cap relative to large cap, they run in cycles. This has been a painfully long period of small, mid-cap underperformance. And it was really out of frustration that I wrote a piece back in June and basically titled it The Overlooked Asset Class. And in the paper I wrote, it's a spring ready to unspring. But so I feel like we're already seeing this shift. And again, I'll refer to NVIDIA today, which had fantastic earnings results last night, and everything is great, and the stock was down 8% today. If I ask 10 people how NVIDIA has done since last June, 12 of them will tell me that if it's up or down, 12 of them will tell me that the stock has to be up because it's the IT stock with the most stocks down. So the stock is telling you something, that it's tired. It needs a rest. The valuation isn't even that expensive now. I think it's trading at a PEG ratio of 0.6. It's below its growth rate. So it's lower than the S&P. But the market. So then I think about, well, what makes stock? I always go back to what makes stocks go up. More buyers than sellers. Who doesn't already know about the artificial intelligence revolution? What's an incremental reason to buy NVIDIA right now? In the short run, it seems like no one really knows. So, but this is endemic. The S&P 500 has never been this concentrated in its history. We all hear about the Magnificent Seven. But it's extraordinary. And when I wrote this paper in the spring, Apple's market cap exceeded the total market value of the Russell 2000, which is hard to believe that 2,000 stocks aren't worth what one company is worth. I mean, there's a lot of really high quality companies in the Russell 2000. So that was kind of getting me thinking that, well, what are the conditions? You need certain conditions to shift things around here. It has to be, it just can't stay this way. Otherwise, there's no hope for capitalism. We're just going to have, a couple dozen stocks and that's going to be it. But that's just not the nature of our economy. So, so I started doing some work, and large cap valuations, the way I think about it, the Mag 7 are above 30 times earnings. The S&P 500 trades at 21, 22 times earnings. If you equal weight the S&P 500, it's right now about 18 times earnings. But if you look at profitable small cap stocks, they're around 16, 17 times earnings. So they're attractive from a valuation standpoint. And there's obviously a strong relationship between interest rates and stock performance. Now, at the time when I wrote this, I thought that, we were closer to having the Federal Reserve begin to lower interest rates. Small cap stocks tend to be more correlated to declines in short-term interest rates, simply because many of them finance with floating rate debt and utilize those kinds of facilities. So, lower interest rates definitely helps with that. The Fed moved aggressively in the fall. We had a huge move in the Russell 2000 as a result of that and the November election in the United States, only to see it reverse when indications were that the economy was holding together very strongly, and inflation was still sticking around. So I just think this is pushing out the inevitability of this of small caps beginning to outperform large caps. And then the earnings and growth trends. In the middle of the AI revolution, we really had a profits recession in the stock market. It was just masked by a handful of stocks that were just showing very, very high growth because of the artificial intelligence revolution. And small cap certainly bore the brunt of that. And think about what happened. You had huge disruptions globally in supply chains that affected small caps, small and mid cap stocks disproportionately more. And a whole host of other end demand factors where they had excess demand, they couldn't meet it, and when they finally could meet it, they had too much inventory. So it was very, very hard for small to medium-sized companies to manage through all this turmoil, and really caused a prolonged profits recession. But it was just masked by incredible strength in the deployment, and then of course, along the way, we had a mini banking crisis in the middle of that too, with the demise of Silicon Valley Bank and others as a result of that. So, I started doing some history on the industry, going back to really assess where the cycles were of large cap versus small cap performance. And it came to, when we did the work on this, we came to the conclusion that this was the second longest period of underperformance since 1931. Well, I believe in the concept of mean reversion, and eventually, things are going to change structurally that are going to cause some sort of attention to come back to this end of the market. So, we've had this concentration of leadership, and again, when I wrote this paper, and I'm happy to send it to, I'll send it to George. He can certainly distribute it to everybody. But I've never seen concentration like this, and I just think that I cautioned everybody that this isn't a trade. It's a rotation, and it's going to take it's going to take some time for it. But I'm convinced after seeing the reaction of these larger cap stocks, almost every stock with the exception of Meta of the Magnificent Seven are down this year. And some of them are down by a lot. Well, where's that capital going? It's not leaving the stock market, it's getting recycled to the broader areas of the market. So you can see that in the relative outperformance of the equal weighted S&P relative to the S&P, but there's a derivative effect as you go down to small cap stocks. Yes?
So the tendency is the chart. So the last small 12 years, 1999, 2010, last
Yeah.
time zero.
So what happened, yes, so that's
So small outperforms large
by 5% annually.
annually.
Yes. Huge period of, think about what happened in 2000. You had a blow-off top in the internet stocks. The quality of those companies was terrible back then. It's nothing like the quality of the businesses that we have today in terms of their free cash flow and measuring companies on eyeballs. And one of the other ones that peaked then was General Electric, too. That was when GE made its all-time high in 2000. And it's only recently, it's not even back to its all-time high when you add all the pieces together. I like to talk about Cisco Systems. That was at its time approaching $1 trillion of equity capitalization by 2000. And it was around, I think at its peak, it was around $80, $90 per share in that range. Went down to $10, and it's only recently $50 or $60 a share on the recovery. So, you think about how long this period of underperformance for what were then the bellwethers, it's really amazing. But through that period from 2000 to 2010, my Genesee in Wyoming and a lot of companies like it, that's when those stocks really started taking off. There was a shift more towards the market broadened out, and tech was the last place you wanted to be. The tech weighting, I think, in the S&P at that time, maybe had gotten up to 50%. It was a ridiculously high number. I don't think it's anywhere close to, it's still in the high 30s now, or the mid 30s now in the S&P. But because of the crazy way that it was, the crazy outperformance of a lot of the tech names back then. And then, of course, we had high-profile bankruptcies like Enron and WorldCom back then, where you just wiped out billions and billions of dollars of market value there. But that set off a big rally in small cap stocks until the end of the global financial crisis. That's when valuations got ridiculously low for large cap stocks, and that set off an unwinding of the process. And I really think what hurt, it's interesting. The NASDAQ is the only index. It's only had one down year since 2010, and the one down year was 2022. Rebounded in 23 and 24 because of the AI revolution, and we'll see what happens in 25. But I think the setup is, I think it's very favorable where we're going to start to see the turn. So what are some of the key things that we focus on? And this was also, I thought, very interesting. The relative, you would always expect that large cap stocks are going to trade at a premium to small cap stocks when looking at something like price to book. But what should the premium be? Well, it's right at the level where you tend to see the trends begin to reverse themselves. The only other time it was higher was 1931, when large cap stocks were trading at 300% of book value, of price to book relative to small. Now it's 242%. So it's the second highest. So there's clearly valuation excess here. And I didn't mention, the Russell 2500 equally is incredibly undervalued as well, in my opinion. Any combination of Microsoft, Apple, and NVIDIA, combining two of those three, is almost the market value of the Russell 2500. And again, the way that index is configured, it's the 500 mid-cap stocks. So these are companies with market caps of $7 to $20 billion in them. These aren't small companies. These are well-established companies. So again, this is the largest trading at the highest premium from a book value, from a price to book since 1931. When I wrote this, I really, and I still believe today, the Federal Reserve and the interest rate cycle really are going to hold the key here. You know, we had a bad inflation print 10 days or less ago, and the index that bore the brunt of that was the small cap index. Now, I hate to rely on government statistics; they're notoriously unreliable in terms of how they calculate some of these things. You know, and I think some of the economic statistics are likely going to be very noisy, even more noisy because of the fires in California. We had hurricanes in the South, so there's going to be some distortions that's well above my pay grade to figure out where those distortions are. But I always try to string several together. So I just think, suffice it to say that I think the Federal Reserve is going to just stay pat and not lower rates for a little while. So instead of, you know, I think we started off in the summer thinking there'd be 4 cuts in 25. I'll be happy if there's 1, because I think next year you'll see more. So this is, I think we're going to see higher earnings growth in the Russell 2000 and the 2500 this year. You can already see it, the rate of change. Again, it's just gravity. The law of large numbers does matter a lot. You know, NVIDIA is still having incredible growth, but that growth rate, it has to decelerate because of how big the numbers are now. Conversely, I think we're coming out of this long period where small cap stocks and mid cap stocks, because of what happened vis-a-vis, you know, some of the supply chain issues that I mentioned, really hurt the profitability of these companies, and I think that's turning now. And you know, they generate most of their, you know, I'm not saying they're immune from tariffs, but you know, a regional bank probably isn't going to have a lot of problems if there's tariffs with other countries, you know, unless it really has a very broad impact on the economy. And, you know, the prospects now of deregulation, I think, disproportionately help financials versus other sectors, but certainly other sectors will benefit from it as well. So, yeah, this is the earnings growth driver, you know, the annualized growth. I apologize, I neglected to move the slide forward here. So we're seeing better growth. We're likely going to see better growth in the Russell 2000 and 2500 this year in those companies. And we just had a very good start to the year from an earnings standpoint. You know, pretty much not too many surprises on the downside. A little bit more towards the upside on the revenue side. So to conclude, you know, I had no idea who was going to be the president when I wrote this, but M&A is coming back. We're already starting to see a pickup in that. This administration has a different view on merger and acquisition activity. Again, we tend to see more M&A in our portfolio, I think, because we focus on companies that do something that's different, unique, differentiated, and has a moat around it. You know, is doing something, you know, that's just differentiated. So if you're another company and you like that moat or the business that's been built, you can either try to replicate what they're doing, or you just buy the company. And more often than not, it makes sense to buy the company. And then again, you know, I think ultimately, if we're going to, you know, reshoring of supply chains, you know, started in the first Trump administration, and it really is inevitable because once corporations don't forget, they had near-death experiences with disruptive supply chain issues because of, you know, what happened because of the pandemic, but having so much of your supply chain be in one region of the world just does not make any sense on any. And a year and a half ago, I gave a speech in Ohio to the Regional Association of the Iron Workers Union, and they told me that they had a 5-year backlog on projects to build plants throughout the Midwest, infrastructure type projects. And I really didn't know, is that a good number? Is 5-year good? He goes, no, we've never even had anything close to that. 5 years. Our biggest problem is getting people to do this kind of work, because it's a skilled trade, but it's a lot of manual labor. So I asked if the Inflation Reduction Act had played any role in that demand. He said no. These were global corporations that were just rethinking their supply chains and where to put it, and the U.S. looks better all of a sudden. Not for everything. We're going to focus on making higher value-added types of products. I think the president's the consummate negotiator, and he's trying to get companies to really focus on moving manufacturing as much as you can. Warren Buffett wrote a piece back in the early 2000s and raised the alarm bell then that we were shifting too many jobs overseas. And those numbers have just gotten exponentially larger. I met with Robert Lighthizer, the president's advisor on trade, a couple of weeks ago down in Washington, and he cited these statistics. And there's real issues. I mean, tariffs is just a means to an end to negotiate. I do believe it's a tool. I do think that a lot of the tariff-related activities are really targeted to China right now, but I think it'll be negotiated. I also think that reciprocal tariffs is very difficult to say that reciprocal tariffs are unfair. If somebody tariffs a good that we're exporting, why shouldn't we put a reciprocal tariff on that? The public at least can understand something like that. So we'll see. I ultimately think that's how it's going to be used to sort of balance these imbalances of hollowing out our manufacturing base. And I think small cap and mid cap stocks will be a big beneficiary of that. So I'm going to stop there. The last page is just a bunch of important information from our legal department. That everything I said could be a complete lie, and I could have lost my mind here, but I'd love to take questions and make this just really a discussion and hear what's on your mind, and see if I can answer any of your questions, as long as you don't make them too hard.